The cryptocurrency sector is going through a regulatory phase, with many governments trying to better understand how this new technology can be utilised and be kept safe for users. At its height, the global crypto market capitalisation was close to $2 trillion. In May, billions of dollars were lost due to the fall of Terra's stablecoin, UST. According to CoinMarketCap, the crypto market cap is currently close to $1.25 trillion globally. And although in somewhat of a sideways, range-bound phase currently, Bitcoin, Ethereum and other altcoins are prone to volatile price swings. In order to be used as a store of value and a mode of exchange, currencies need to have stable prices. Now, to give you an example, a 2% price move on the foreign exchange market is practically a landslide. Stablecoins are a type of cryptocurrency that are pegged against the value of existing assets and were invented after Bitcoin and Ethereum. Although CNN's Fear and Greed Index to measure the overall market sentiment is on the border of fear and extreme fear at the time of writing this report, the retail investors aren't the only ones investing into crypto. It was reported by the Financial Review that 1.6 million of Bitcoins were owned by corporations and governments. This equals about 8% of the total global supply. The largest holdings of Bitcoin by nation states are by Finland, Ukraine, El Salvador, and Bulgaria. Currencies during the era of the gold standard were pegged to the value of gold. This ended in 1931 for Great Britain and 2 years later in 1933 for the United States. And these days, the reserve currency model is used. At the end of World War II, the US dollar took sovereignty over the British pound and became the global reserve currency, which now has close to 14 currencies pegged to its value. Stablecoins were invented to give investors access to digital assets with less volatility, since their value is pegged to existing assets, such as the US dollar. In this way, stablecoins can offer the benefits of low transfer fees and high transaction speeds for large amounts of money. Stablecoins are backed in three main models to create collateral. Fiat-backed. Being backed by a fiat currency like the US dollar allows a stablecoin to maintain its price with low volatility. Collateral can also be created from precious metals and commodities. In this model, the collateral backing the stablecoin is held by a custodian, and to guarantee a fair exchange for the value stored in stablecoins, they have to be audited. Popular fiat-backed stablecoins include Tether and TrueUSD that are backed by the US dollar. Tether has also introduced a stablecoin pegged to the Mexican peso recently, and Australia's ANZ Bank has created a stablecoin pegged to the Australian dollar. Cryptocurrency backed. You can also have stablecoins backed by cryptocurrency. Now, in this model, the amount of crypto kept in reserve is at a higher level than the circulating coins to reduce the impact of volatility. Algorithm backed. Sometimes thought of as controversial as they technically aren't backed by collateral, and the recent depegging of Terra's USD, or UST for short, is a fine example, which used an algorithm to peg to the value of the US dollar. Billions of dollars were lost due to the fall of Terra USD stablecoin. Although they have launched Terra 2.0, some are of the opinion that algorithmic stablecoins will not have a future. Other stablecoins that fell along with Terra USD include Scream's DEI algorithmic stablecoin, also depegging, losing close to 50% of its value mid-May. This left the Scream protocol in millions of dollars of debt. Scream is a DeFi protocol in Phantom's ecosystem. As previously mentioned, some stablecoins can be backed by precious metals like gold and silver, as well as commodities like oil. And two popular gold-backed stablecoins are Pax Gold and Tether Gold, which can be seen in the top 300 cryptos as their market cap increased exponentially since 2021, with Tether Gold outperforming Pax Gold. Although Tether's stablecoin is pegged against the US dollar, it did drop to close to 96 cents mid-May briefly, although it's currently stable, varying a cent or two from the US dollar. So to sum it up, stablecoins are used in DeFi protocols in yield farming and staking to earn annual percentage yield, or APY for short. And last year, some protocols were offering APY averaging between 30 to 60%. This year, if you check a DeFi aggregator such as CoinDix, over more than one day, you will see that when some protocols advertise a high APY close to 40%, one day it may be back down to 1 to 5% the following day. The total market cap of DeFi has dropped significantly, from close to $200 billion to approximately $80 billion. So be sure to do extensive research into the space before you begin investing. If you like this information, please like, share, comment on the video below and subscribe to the channel. Press the bell icon to be notified of the most recent videos from Kalkine. For more articles, check out the website kalkinemedia.com. Sage here for Kalkine Media.